Okay, dear students, let's just start. Bismillahirrahmanirrahim. This is our first live revision class for March session 2025. In today's class, since it's a first class, will not be so long. So in the first class, we'll be just revising a few concepts of investment appraisal, and from the second class, inshallah, we will revise the investment appraisal through questions. Okay, and questions will be from the past papers. And majority of the question which we'll be doing, they will be from the recent past papers. Okay. So investment appraisal. FM first live revision class. The session is March 2025. In investment appraisal, the first topic is NPV, net present value. Now, what are the, you can say, basic or main principles of calculating NPV? The very first concept is only relevant cash flows are considered. Let me give you a quick overview of the relevant cash flows since it's a revision class. Only relevant cash flows are considered. Relevant cash flows means number one, future cost is relevant. It means the past cost is not relevant. The past cost is sunk cost. Today, whatever decision you are going to make, the past cost will not be recovered. So basically, future cost is relevant. Past cost, another name for the past cost is sunk cost. It is irrelevant. So only the future cost is relevant. So only relevant cash flows will be considered. So number A is future cost is relevant. Another thing is either it is an inflow or it is an outflow. It must be because of the project. It should be caused by the project. So cause by the project. Caused by the project means, for example, we are talking about actually incremental cash flows. We are talking about opportunity cost. Obviously, because of the project, if I'm going to bear any opportunity cost, so that is relevant for me. And the last point is, by definition, must be a cash flow. But there is an exception, except tax depreciation. The exception is tax depreciation. Another name for the tax depreciation is capital allowance. Actually, tax depreciation itself, it is not an cash outflow. In fact, tax depreciation itself is not a cash flow at all. But still, while calculating NPV, we do consider capital allowances. Now the question is, why we are considering capital allowances if it is not a cash flow? There's a reason. Can I say capital allowance itself, it is not a cash outflow, but because of the capital allowance, because of the tax depreciation, organizations, they will say they are saving the tax. That is why we do consider this capital allowance. Another name is tax depreciation. So what is the reason of considering the tax depreciation? Because tax depreciation results in tax saving. That is why it becomes relevant. The tax saving part is relevant. Okay. Now, your existing fixed overheads are irrelevant. Your existing fixed overheads are irrelevant. The question is why existing fixed overheads are irrelevant. The reason is because your existing fixed overheads, they are not incremental. That is why existing fixed overheads, they are irrelevant. Now, your examiner can use different terminologies for the fixed existing overheads. Like, one possibility is allocated overheads. Examiner can use the term allocated overheads for your existing fixed overheads. Second, apportion overheads. Third, absorbed overheads. Examiner can use the term applied overheads. And the last but not the least, examiner can use the term ABC allocation. Now listen carefully. Activity-based costing allocation. Either your organization is following the absorption costing or ABC. In both the costing, your total overheads, they will remain same. Only the difference is between allocation. ABC claims that we will tell the organization what is the fair allocation of the overheads. So for us, the main concept is either organization is following the absorption costing or ABC allocation. Existing fixed overheads, they are irrelevant. Obviously, if your examiner uses the term additional fixed cost, obviously relevant. Additional fixed cost is relevant. Okay. Now, another point which is extremely important. What is that? If your examiner is saying any, as we have already mentioned, any past cost, sunk cost is irrelevant. Past cost, that is your sunk cost, is irrelevant. So past cost, sunk cost is irrelevant. For example, now listen carefully. If your examiner says before starting the project, organization has incurred R&D, research and development expenditure. So whatever cost organization has incurred on R&D, that is irrelevant. Before, which is they incurred before starting the project. But if examiner says organization has incurred R&D of $1 million, let's say before starting the project, and it is written in the question that after starting the project, for example, 10% of the variable overhead, 10% of, let's say, uh, variable 10% of variable cost will be your R&D. Let's say examiner says, another possibility, examiner says after starting the project you will have to incur R&D. So basically R&D which I have incurred before starting the project, that is irrelevant. But if I'm going to bear any R&D cost after starting the project, then it is relevant. Okay. Now, when we say cash flows, now very important concept is coming, cash flows. Basically, there are two types of cash flows. One is real cash flow. Real cash flows means without inflation. The second is nominal cash flow. Another name for the nominal cash flow is money cash flow. There is third name also, monetary cash flow. So examiner can use the term nominal cash flow, money cash flow, or even examiner can use the monetary cash flow. Actually, nominal cash flows means with inflation. Okay. If your cash flows are real, then cost of capital will be real. If cash flows are nominal, then cost of capital will be nominal. Okay. Now we need to discuss how to convert real cash flows to nominal. And then we'll be discussing how to switch convert real cost of capital to become nominal if it is needed, or nominal cost of capital to become real. But before that, look at this. Conversion of real cash flows to nominal cash flows. Number one, if your examiner says current prices, the term examiner is using that is current prices or real term prices, or examiner is using the term year zero prices, or examiner is saying present day prices. Or examiner says above prices are without inflation. All of them means the same thing. Inflation will be incorporated from the first year. Inflation comes from the first year. So examiner can use any term. I said 5 terms, I've written 4. The one is current price, second is real term price, third is year zero price, fourth is present day price, fifth, if your examiner says above prices are or given prices are without inflation. So it means again the inflation will come from the first year. Second possibility, if examiner says first year prices. If first year prices are given, then inflation you have to incorporate from the second year. Inflation incorporate from second year. Why? Because when we say first year prices, it means first year inflation is already incorporated. It is like that if someone is saying 2024 price. Obviously, if I'm saying 2024 price, it means inflation of 2024 is already included. Now come here. I want everyone to attempt this few questions quickly. T1, T2, T3. Current price is, let's say, 100, 100, 100. Inflation per annum is 12%, 12% and 12%. The requirement is nominal price. I want everyone to quickly use your calculator and tell me what are the nominal prices. The nominal price is simply, can I say 1.12? Then 1.12 square, and then, so number one is 112. Second, you can directly multiply 112 with 1.12. It is up to you. Students, please check. I'm getting 125.44. And the third one I'm getting is 140.49. So make it 5. Please check. Everyone is having the same results or a different result. Okay. Question, that was 1. Question 2. T1, T2, T3. Average current price. Let's say per unit. 100, 112.5 and 115. This is average current price per unit. Inflation per annum. Let's say the inflation per annum is 10%, 10%, 10%. And the requirement is nominal price. So how will you calculate nominal price? Simply 1.1, now power 2, and then power 3. So 110. 112.5 into 1.1 and then is squared. Students, I'm getting 136.125. Now you cannot calculate directly. If someone multiplies 110 with 1.1, you will not get 136.125. Previously, if someone had multiplied 112 with 1.12, so the answer is 125.1, 125.44. But right now it is not possible. Why? Because every year the amounts are different. So now there's only one way, that is 112.5 into 1.1 power 2, then power 3. Now please, I want the third one to be attempted by everyone. I'll give you around 1 minute. T1, T2, T3, T4. Average current selling price 100, 110, 15, 118. Inflation per annum is 15%, 12, 16, and 30. The requirement is nominal price. Please, I want everyone to attempt this and give me the nominal price, then we'll solve it together as well. You have 1 minute to do it. Okay, student, look at this. Number one is 1.15. I'll get 115. The second one is important. 1.15, then 1.12. So let me use a calculator. I'm getting 141 point. Now this time you will not take power 2, power 3 because inflation rate is different in every year. That is why we cannot take the powers. Previously, inflation rate was same. You can see that. Then I took power, that is square, then cube. The same thing is here. So when inflation rate is same, then obviously I'll take the power. But if inflation rate is changing, you cannot take the powers. So 115 multiplied by 1.15 multiplied by 1.12 multiplied by 1.16. I'm getting 171.8192. Here it will be 1.15, 1.12, 1.16, then 1.13. So 118 into 1.15, 1.12, 1.16, 1.13. I'm getting 199.22. So this is how we incorporate inflation. This is how we convert real cash flows to nominal. Now, we have a Fisher effect. By using Fisher effect, we can convert real cost of capital to nominal, nominal cost of capital to real. And we will also discuss later on how do we convert nominal cash flows to real cash flows. Right now, we have just discussed one thing, how to convert real cash flows to nominal. But we have to discuss how do we convert nominal cash flows to real. Before that, Fisher effect. By using Fisher effect, we can convert real cost of capital to nominal or nominal to real. So the formula, the relationship is very simple. 1 plus nominal rate is equal to 1 plus real rate into 1 plus inflation rate. And this inflation rate is not a specific inflation rate, it is a general inflation rate. Repeat. In Fisher effect, we use general inflation, we do not use specific inflation. Now, what do you mean by specific? Let me give you few examples of specific inflation rate. For example, if your examiner says selling price will increase by 10%, variable cost, let's say, will increase by 8%, it means these are the specific inflation. So in Fisher effect, we do not consider specific, we consider general inflation rate. Now, the formula is very logical. Nominal means with inflation. So you can see that 1 plus real rate into 1 plus inflation rate. So we are incorporating inflation to the real rate. So obviously it will become nominal rate. Let's see a question. For example, real rate is 10%. Nothing is mentioned, then it is assumed that given inflation is a general inflation. Inflation rate is, let's say, 5%. An examiner is asking us to calculate nominal rate. Always remember one point. Nominal rate will always be higher than real rate. Now let us use the formula. Nominal rate is equal to 1 plus real rate. That is, it becomes 1.1. 1 plus inflation rate, so multiply by 1.05. Okay, let's see. Let me use the calculator. Simply 1.1 into 1.105. Nominal rate is equal to 1.155. So plus 1, if when I'll take this plus 1 to the other side of is equal to, it becomes minus 1. So nominal rate is 0.155. If you multiply 0.155 with 100, so nominal rate becomes 15.5%. So simply 1 plus nominal rate is equal to 1 plus real rate into 1 plus inflation rate. Okay. If I need to convert nominal rate to the real rate, then formula is a bit different. Real rate is equal to 1 plus nominal rate divided by 1 plus inflation rate, and we know that we are talking about general inflation. Minus 1, minus 1. So 1 plus nominal rate divided by 1 plus inflation rate minus 1. Let's see. Examiner says the nominal rate is 12%. Inflation rate is 4%. And we are required to calculate real rate. Obviously, by using Fisher effect, we can convert nominal rate to the real or real rate to the nominal. So now let's calculate real rate. And we know one more concept, that is nominal rate will always be more than real rate. Now we are calculating real rate. Obviously, real rate will be lower than the nominal rate. So 1.12 divided by 1.04 minus 1. Let me use the calculator. 1.12 divided by 1.04 minus 1. I'm getting real rate 0.0769. When I'm going to multiply this with 100, so I'll get a real rate percentage 7.69%. So the real rate is 7.69%. Okay. Now, another very important point. What is that? We have already discussed one point. If your cash flows are real, then your cost of capital will be real. When your cash flows are nominal, your cost of capital will be nominal. Now, let's see. For example, now very important concept right now I want to discuss, so you have to listen this. We just need few more minutes. T1, T2, cash flows. Let's say 100 and 200. Discount factor cost of capital is, let's say, 10%. So 0.909 and 0.826. We'll get present value of cash flows. 90.9. Let me use the calculator. 200 into 0.826. 165.2. Okay, now the same cash flows, T1, T2. Cash flows 100 and 200. Examiner says inflation rate is 5%. Let's say inflation per annum is 6%. So 1.06 then into 1.06. Assuming inflation rate is 6%. Okay. So it will become 106. That is now nominal cash flows. We have converted real cash flow to nominal. 200 multiplied by 1.06, the power is 2. I'm getting 224.72. Now please listen carefully. These are the same cash flows 100 and 200 which we have used here. We discounted them at 10%. Now in the same cash flows we have incorporated the inflation. So now the nominal cash flows are 106, 224.72. It means that above cash flow 100 and 200 is real, because in real cash flows we incorporate inflation to make them nominal. Since I have converted real cash flows to the nominal cash flow, it means now we have nominal cash flows. If you have nominal cash flows, then discount factor must be nominal. In the given data, 100 and 200, we discounted them at 10%. Since 100 and 200, they are real. So this 10% is also real. Now we have to convert this 10%, which is a real discount rate, to the nominal. Why? Because cash flows we have converted from real to nominal. So we have to convert the real cost of capital to nominal. Look at this. Nominal rate is equal to real rate is 10%, 1.1 into inflation 1.06, whatever comes minus 1. Let me use the calculator. 1.1 into 1.06 minus 1. I'm getting 0.166. After multiplying 0.166 with 100, I'll get 16.6%. So the nominal rate is 16.6%. Now let's multiply this. Discount factor for the first year, 1.166 minus 1. Let's see what is the discount factor. 1.166. The power is minus 1. 1.166, the power 166, the power is minus 1. Students, I'm getting 0.8576. Let's see here the discount factor for the second year. 1.166 power power minus 2. I'm getting 0.7355. Present value of cash flows. 106 multiplied by 0.8576. I'm getting 90.9. 224.72 multiplied by 0.7355. I'm getting 165.28. Now please, the main concept is coming, so concentrate. Look at the first one. 90.9, the same is here. 165.2 and 165.28, it's the same thing. Now listen carefully, the concept is, I'm telling you, and numerically I have proved that. Now listen. If there is only one inflation rate in the entire question, and which is the general inflation rate, if all the cash flows, they are subject to general inflation rate, and in the entire question there is only one inflation rate which is a general inflation rate, in that case please listen carefully. It makes no difference on the present value. Either you are discounting the real cash flows or you are discounting the nominal cash flows. Like we have seen that The real cash flow is 100. Real discount rate is 10%. This is the present value. Nominal cash flow is 106. Nominal discount rate is 16.6. The present value is same. Actually, what happens? Due to general inflation rate, it is not only the cash flows they are increasing, your discount rate is also increasing. So it has no impact on present value. Present value will remain same. So let me repeat, whenever all the cash flows they are subject to only a single inflation rate, and that single inflation rate is a journal inflation rate, then present value will be same. Either you are doing discounting of the real cash flows by using real discount rate, or nominal cash flows with the nominal discount rate. You can see that. Now there's one more concept. If someone asks you a question, when it is compulsory, when it is necessary to calculate NPV in nominal terms. Now listen carefully. If there are different inflation rates in every year, if inflation rates they are changing, or you can say one more thing. When there are more than one inflation rate in the entire question, for example, selling price is having a different inflation rate, variable cost is having a different inflation rate, additional fixed cost is having a different inflation rate. So if in the question there are more than one inflation rates, then you have to calculate NPV in nominal terms. Otherwise, if there is a single inflation rate which is a general inflation rate, then either you are calculating present value in real terms or nominal, it makes no difference. Now, student, listen carefully. It is just the first live revision class for March 2025 session. That is why it is not long. Second, from the next class, inshallah, we will be doing the revision of investment appraisal by using questions from the recent past papers. So I really want every one of you follow the proper planner. I think admin has shared the planner with you. If still you have not received the planner, you can ask the examiner, admin. Admin will share the planner with you. So please, thank you very much that you people have taken out time for your first live revision class. Uh, from the second live revision class, the time duration of the live revision class will increase. Okay. So thank you very much.